Hello and welcome back to another Overseas DeFi live stream. My name is Brandon, co-founder of Overseas DeFi. We do this live stream every Thursday night at 6 p.m. Eastern Time. It is your chance to learn something new about crypto and DeFi. And as well, it's an opportunity to ask me any questions. If you're trying to put together a crypto and DeFi portfolio and you get stuck along the way, we have plenty of videos on the channel, but you can tune in to these live streams, ask your question in real time, and I'll do my best to provide the answers. Bad news is the crypto market is continuing to stay in this bearish downtrend. But the good news is tonight I'm going to give you 3 strategies for making some pretty nice gains, some pretty good income during a bearish market. So 3 strategies that you can lock in and start to use in your portfolio to generate money and generate returns when the market is bearish like this. So first off, let's just take a look at the Ethereum chart here. Very clear downtrend. And I do believe I'll get to these lines and this support zone box that I've drawn here in a moment. I do want to zoom out though and just give you a bigger picture of where we are in this market. Could even go out further to a weekly chart, but you can see on the daily chart, we're pretty low in this range. Ethereum has been trading in this sideways range for, gosh, almost 4 years now. Excuse me. XAU USD. XAU? XAU, that is I believe that's gold. So that looks to me like a Forex pair, Alex. XAU USD, I'm pretty sure that's the gold Forex pair. So not really in the scope of what we talk about here, but appreciate the question. And sorry, just got distracted there for a second. So this market has been range bound for the better part of 4 years. And you could definitely argue for the idea that we are pretty low in this range. Also, I would say the area, the zone between 2000 and 2100 has been a very active zone of price. You can see when I move my cursor here between 2100 down to 2000, there are a lot of lows and even some highs that match up in that zone, either somewhere between 2100 down to $2,000. So it's a very active zone of price where traders are going to come in and act on the market and act on the price. In particular, we've seen this recent sweep below below 2000, and then we recovered that level, and now we're coming back down to test it out from above. This is part of the reason why I've drawn this support zone. I'm going to zoom in a little bit further into a 4-hour chart and just show you a couple of things that I'm looking at on ETH. ETH is the crypto asset that I hold the most of in my crypto treasury. I'm very bullish on, excuse me, very bullish on Ethereum in the long run. And I trade it the most often in my portfolio. This is the asset that I use for all of my hedges, all of my short positions on the futures exchanges, as well as my main cash flow engine where I'm generating that daily cash flow. And that's going to be a big part of the stream tonight, is looking at ways that you can generate cash flow every single day from your crypto assets, even in a bearish market. Matter of fact, these liquidity positions that we use when the price is dropping quickly, if it's still in your range, the yields are quite high. So there's extra volume in the market whenever the price is dropping rapidly, and that leads to more yield for us liquidity providers. So you can actually not only make income, but make very good income even in a down market. So what we've seen here since the just before the big February 5th flush down, where we saw ETH go down below $1,800. Notice this high right here, right around 2,400. Excuse me. And then we had a double top right in here, and we had a series of highs in this area as well. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 tops, all in alignment there, really solidifying the top of this local trading range. So big picture, we're in a big giant trading range from about 2,000 all the way up to 4,500 or so. In a narrower picture, just looking at the local price action, we are also trading within a range. The top of that range is very clearly planted at about $2,400 ETH. So this, how can you use this information? Well, one of the strategies, two of the strategies that we're going to talk about tonight involve shorting the market. In other words, opening up a trading position in crypto where you actually make a profit when the price drops. So if you're shorting an asset, you want to do that at the highest price possible. So when price was in this area, right around 2,400, this was a very low risk entry point for us in our community where we were establishing our short positions. And I'll show you exactly how that ended up playing out in my GMX position, which is a perpetual futures exchange. So clearly delineated top of the local range here. And the bottom part of the range is a little less clear. And what I'd like to say, or one of the things I'd like to point out here is that we have consistently made a pattern of higher highs. So we had the low there, excuse me, higher lows, I should say. I misspoke. The low there was a bit higher. The low here, yet again, a little bit higher right there. And this most recent low, now I don't know how long this low is going to last, but once again, we've made a slightly higher low. So it's a little bit on the bullish side, and it sort of corroborates the idea that at the moment, price is relatively low in this localized trading range. Let me delete all of those little guys. Here, let's do it the quick way. Come over here. If you didn't know about the object tree within TradingView, I actually love this feature. You can see everything I've drawn on my chart gets a line item here in the object tree. And so if I want to delete all of those brush strokes that I just drew, I just can highlight all of them and delete. Perfect. All right. That's accessible right over here. Bet you didn't know you're going to learn something about TradingView on the stream tonight, but there you go. Little quick tip about TradingView. Anyway, we've had that pattern of higher lows, and we've also had some price action that again highlights that zone of support. So the zone of support that I'm looking at currently is from 2000 all the way up to 2000, about 2060. And I call this a zone because the lows in this area are they're kind of uneven. They're staggered higher and lower prices. So they all kind of fall within the same zone. Now, I understand there was a little bit of an excursion right here, but the market quickly took care of that, quickly rectified that situation, pushed higher, and then we came right back down into that zone where the support started holding. And then look at this breakout right here. We come down and we test that exact top of that zone and push higher. So this is clearly an area of price where traders and investors are interested in this asset. And so this gives us a range to work with where we know we can kind of define what's a high price in the current market and what is a low price in the current market. So this is what's going to inform our decision to unwind those short positions. So again, a short position is any kind of a trade where you're profiting as the price is coming down. And then what you have to do when you're trading that way is you have to cover the short, meaning you have to buy the asset back to unwind and close out that position for a profit. So we like to recently, we've been entering our short positions somewhere up in this area between 2350 and 2400. And then I just recently unwound my GMX short position right in this zone. So let me show you that real quick, just to give you an example. This is one of the main strategies we can use to generate profits and income and returns, even when the market is heading down. So this is GMX. This is a futures protocol. This is a decentralized futures exchange. It just means that I can do everything within my self-custody wallet. So you can use Rabby for this. We use Rabby for everything in EVM. I am using my Rabby wallet and the Arbitrum blockchain to fund this account. You can see my wallet is connected and I have about 15,000 in USDC in my wallet. If you want to trade this market and trade this futures contract, this is a perpetuals futures contract, means it never expires. You just basically are betting on the price. Now I've got a lot of different analogies, and my favorite analogy for trading the futures is this is sort of like betting at the casino. And with this betting, I mean, you're literally betting on what direction the price is going to go. If you believe the price is going to go up and you want to profit when the price goes up, that is called long. So you would use this protocol and you would bet long, and you would profit if the price goes up. You would lose money if the price goes down. Vice versa, if you believe the price is going to go down, or you want a position that's going to profit when the price goes down, you're going to bet short. So those are your two choices. You just bet long. If you're bullish, you bet short. If you're bearish, if you think the price is going to drop. So what we did here, and you can see my trades here, I opened the position here at 23.89. Okay, so I opened a short position. I clicked on short and I used a limit order to enter the market short. And then I added on to the position down here, just a small amount, a little bit extra juice on that trade. Obviously, I wish I had added to the position up here. Anytime you're shorting the market, the higher you can get in and enter that trade, the better, right? And then if the price drops, you're making more profits as it moves down. And then I closed out part of the position right here. You can see I took profits at around 21.68. The reason for that was technical. So I believe that support would come into play in the lower part of this range. You could see there was a little 1 hour time frame range right here, and this was right at the bottom. So I did partially close out the position right there at 21.68. So it was actually closer down here. And what I did is I basically matched it up with these lows right here. I thought that would be a good place to take some profits. And another thing I do with these short trades, I scale into the position, meaning I enter trades part way. So if the price is going up and up and up, and I'm trying to build a short position, I'll short a chunk at one price. And if the price goes a bit higher, I'll short another chunk. And then if the price goes even higher still, I'll short another chunk. So I build this position as the price is moving against me, and I keep averaging. My average entry price keeps going up a little bit more each time. And then as it's coming down and I'm getting ready to take profits on that trade, I'm going to scale back out. Meaning I'm not going to close the whole position at the first target. I'm going to close out part of the position at that first target, and then I'm going to give the trade some room to keep going further in my direction. And then if it happened to reverse right here, well, at least I took partial profits on the trade, and then I could close it out at a break even on the rest, for example. But it did end up going a bit lower, and I closed my next tranche, my next chunk, at 2030. Now, why did I choose that level? This goes back to this zone. So this zone goes from 2000 up to about 2060. So it's about $60 wide. Notice my target right in the middle. Actually, my limit order was placed at 2030. And then when it actually filled, you can see the exit was at 2029 and 65 cents. So pretty much right in the middle of that support zone. Now, when I saw this bounce, right in here, this is just a few days ago, just over the weekend, I closed out that second chunk. We had a nice bullish reversal right where I expected it. So at this point, my thesis, my idea was that, okay, maybe the low is in and we're range bound. So maybe now the price will recover and it'll head back up to the top of the range. And so I wanted to exit the rest of my position. And you can see I did so right here. The price was just under 2100. So we're kind of leaving that zone. And I thought it was going to go higher. Obviously, it would have been better. Now, that's one thing about trading in any format. You have to deal with imperfection. You have uncertainty. You never know with certainty what the price is going to do. So you just do your best. You try to catch a good portion of the move. And if your technical analysis is telling you we're about to reverse, most likely it's going to head higher back up to the top of the range, just get out of the rest of the position. Obviously, you're always going to have room for improvement in hindsight, right? So try not to get too hung up on the hindsight trading. You'll just drive yourself crazy by doing that. Give me 1 second. So that's strategy number one. You can trade these perpetual futures. Again, I like to use the ETH asset. I'm very familiar with the price action of ETH, and I'm looking at the chart every day, managing my liquidity positions, managing my treasury. And so I have a high degree of familiarity with the way this asset moves and the way the price action plays out over time. So that's the asset that I choose to trade. You could do the same thing with Bitcoin. I believe you can actually even trade oil on this exchange, gold, silver, natural gas, and various other crypto assets. Sol would be a good one. Very volatile, though. Sol tends to exaggerate whatever Bitcoin is doing, but you could even trade Bitcoin, whatever you like. This is the first strategy that I wanted to teach you guys tonight about how to make money when prices are bearish and coming down. Now, the next strategy has to do with our lending and borrowing protocol. So this is a little bit more complex. It's a little simpler, but it's also a little bit more complex in the way that it works. So this is my Aave lend borrow position, my main position. I have a few positions with different lending and borrowing protocols, but this is my main one here. You can see my collateral at the moment with the prices being kind of low. The collateral is about 106,000, and my total debt here is about 65K. Now, at the moment, my debt is mixed. All right. So normally when people do lending and borrowing, most of the time they collateralize their crypto assets and they borrow stable coins. Nothing wrong with that. But when we're in a bearish or even a sideways market like we are now, I want to mix that up. I want to customize my borrowing so that I can benefit when the price drops. And this is exactly what I did. Now, this was set up a while ago. And so rather than going through the history of this particular position, I'm going to utilize our Overseas DeFi app. And we built into this portfolio tracker, we have the lend borrow page. And we built into this tool, this liquidation test tool. So you can see this dashboard reflects my current positions. Here's my other position on the Arbitrum blockchain as well. This is my main one on base. What I'd like to show to you is this liquidation test, because this tool is going to really well illustrate how we can benefit when the prices drop. Okay, so I'm just going to bear with me a second. I'm going to set this up, try to make this as easy as possible. So first of all, we have a price slider here. So you can mess around with the price of these assets, and you can see the prices here in your collateral. Those change as you move this slider up and down. So what I want to do is kind of go back in time, back when ETH was trading at 2,400. I just explained to you on the chart, that was the high area of our trading zone, and that was the point where we wanted to short ETH and other assets to benefit as the price comes from the top of the range back down to the bottom. So I'm going to slide this over to where, let's use that. So you can see the price slider over here, or the indication. This is wrapped ETH. ETH and wrapped ETH are the same thing, if you didn't know how that works. And the price is right about 2,400. So now let's go ahead and kind of refresh some things here. I'm going to delete this. Just going to set that to 0. And let's just suppose that I had, let's say I had 60,000 in debt denominated in USDC. Again, this is the kind of the standard default configuration. Most people that are invested in crypto assets, they have a bullish bias. And so you want to supply those crypto assets. You think you're going to go up in time. And then when you borrow against it, you want to borrow the stable coins, right? Because that doesn't change. Again, not the same strategy when we're in a sideways or certainly a bearish market. By the way, if you're watching this live, appreciate you showing up for the live stream. If you have any questions at all, please don't hesitate to interrupt me and ask any questions, especially if you're trying to put together a DeFi portfolio for yourself and you need some help with any of that. Now, you can see here with the prices up at 2,400 on ETH, and this was back when Bitcoin was trading. Well, I don't think Bitcoin was trading at 87,000. Well, I know it wasn't, but this is just this price slider just equally affects both assets. So anyway, the point is going to be on ETH. So ETH is trading for $2,400, and you can see here my collateral is 126,000, and my loan is roughly 60,000. Okay, so this would be the point at which you would short ETH. Again, the idea is, I think the price of ETH is high right now. I want to benefit if and when the price drops. So let's do what's called a debt swap. Now, we have this tool here where you can just swap your debt right in the protocol. I'm going to change this to 1 ETH. Now, I want you to pay attention to these numbers right here. This is my debt. And the way this is configured, my only debt obligation is this 60,000 USDC. What you can do on Aave, though, is you can borrow ETH as well. And if you've never done that, just simply, as soon as you have collateral, look down here, assets to borrow. You can borrow ETH. You can even borrow Bitcoin. If you wanted to deal with the tokenized euro, you could borrow that as well. So the bearish bet, the short position on Aave or on lending protocol starts by borrowing some of the volatile assets. So let's see how this works. So what I would physically do, and what I actually did on Aave several weeks ago, I borrowed ETH from Aave. Now, when you borrow an asset on Aave, it comes out to your wallet instantly. So you just click on borrow and put in the amount, and the ETH comes from Aave and out to your wallet. Once that ETH hits your wallet, the next step is you go and you sell that ETH. Okay. Now, if I did this when the price of ETH is 2,400, every time I borrow 1 ETH and I go to Pancake Swap or 1inch and I sell that, I'm going to get roughly $2,400. Okay. So the first step is borrowing ETH. The second step is selling that ETH to get USDC. And then the third step would be paying down your USDC debt. So you pay off part of this loan. Now, we made this simple with the app to be able to simulate this and kind of strategize what you're going to do and how it's going to play out potentially. We just have a single button. So you can set the debt swap from, you're going to swap from 1 ETH to USDC. So let's see how this works. I'm not sure if I'm going to hit the minus button or the plus button. It's going to work. Okay, let's hit the minus button. So watch these two numbers right here. So I borrowed 1 ETH. I went to Pancake Swap or whatever decentralized exchange is your favorite, and I sold that for USDC, and then I paid down roughly $2,400 of my USDC debt. So the ETH debt went up and the USDC debt went down. We're not borrowing more or borrowing or paying it off. We're just shifting our debt. We're changing our debt from USDC debt to ETH debt. And the reason why we're doing that will become clearer as I go through this. But notice, again, I'll do this again. If I click that, my ETH debt goes up and my USDC debt goes down. So literally what I did, and I'm not sure if that was my exact number in terms of the USDC, but I did this 18 times. And not really. I think I got it done in about 5 or 6 transactions, but you understand. So if I keep going like that until now I have a debt of 18 ETH, and my USDC debt has dropped all the way down to just under 17,000. The total number is the same. I still owe roughly 60,000. So I haven't changed my total debt obligation. I've just changed the composition of the debt. Okay. Hopefully this is making sense, because now we're going to see how this plays out if you're right and if the price does indeed drop down. Now, recently we saw ETH drop all the way down to just under 2,000. So let's simulate that. Now that we've shifted our debt obligation around, we've changed the composition of that debt. Watch this number. Okay. Watch this number right here. This is the total dollar value of my debt. Now, the ETH, I owe ETH. So it doesn't matter if ETH is $3,000 or $3. All I have to do is pay back Aave in ETH. I have to send ETH tokens back to Aave to pay off this debt. So what you're going to notice as the price drops, watch that number right there. Hopefully this is coming through clearly. Every time the price drops lower, my dollar denominated debt obligation keeps going down. The USDC debt, that doesn't go anywhere. I still owe $16,900 in USDC, but the dollar value of my ETH debt is shrinking every time the price drops lower. So let's keep going. So the price is dropping. You're looking over here as well. You can see what the price of ETH is doing every time I click this button. And notice my dollar denominated debt obligation keeps dropping as well. So let's stop there. So now the price of ETH has dropped just below $2,000. Now I reverse the process. If I want to close out this short position or cover my short, I need to go the opposite way. So now I'm going to do the debt swap once again, but we're going the opposite way. Now, mechanically, how does this work? And this is something I just did yesterday when I thought we had a good opportunity and the price of ETH had dropped. I bought one ETH at 1974. I thought it was a good opportunity to buy ETH below $2,000. So I unwound a little bit of my ETH debt. So mechanically, the way this works, it's just the opposite of what we did before. So if I have a bunch of ETH debt here, and now I want to pay off the ETH debt, I need to borrow USDC. So when you're unwinding this, the first step is you borrow a chunk of USDC. The second step is now you go to a Pancake Swap or 1inch, and you're going to buy the ETH. Before you sold it when the price was high, now you're buying it back when the price is low. Okay, so you borrow some extra USDC, go out into the market and buy some cheap ETH, and then you take that ETH and pay down your ETH loan. Okay, so let's see how this works. So that's the mechanics of it, and let's simulate it here. We'll click the other button. Now I'm unwinding it, and every time I want to buy one ETH, this time it's only costing me $1,991. I sold it back when it was almost 2,400. Now I'm buying it back when it's just under 2,000. So every single ETH is getting me a profit of roughly $400. So let's see how this goes. Is it this button? Perfect. So every time I click this button, I'm swapping from the ETH debt back to the USDC debt. So the ETH loan will shrink and the USDC loan will increase. So we'll go back down. I probably should have done it by twos or something. Now we've paid off all of our ETH debt, and look at the USDC debt. Now remember, when I started this whole demonstration, what was my debt? It was 60,000 USDC. But by strategically mixing my debt composition when the price was high and then unmixing it, let's say, when the price was low, I've shaved more than $7,000 off of my debt obligation. Again, I started with 60,000 of debt. Now I have 52,700. Okay. So again, this is the second strategy I'm going to talk to you tonight about, where we're actually able to make money or financially benefit as the price drops. Right. So I'm on the hook for, I've shaved off a good chunk of my overall debt. I still have my collateral. And if I'm right about this being a low price, well, then the price reverses. It starts going back up again. My collateral is gaining in value. My debt obligation is pretty much staying the same, 52,700 and change. That's not going to go up as the price goes up and goes down, but my collateral is what's going to appreciate as we finally get into the bull market. Yeah, thank you, Big Lou. Yeah, we really like it. My business partner and I developed this whole portfolio tracker app. And one of the great things about this, I don't talk about this enough, is we have this fully trained DeFi AI agent. So this is the Overseas DeFi AI. This is not just a normal chat GPT. This agent is completely trained on all of our IP, all of our intellectual property here in Overseas DeFi. So every single workshop that I've ever taught, every open office hours that we've had, every accelerator strategy call that we've done, all of our video lessons. We're even going to add in our YouTube videos as well. Question and answer sessions that we've had. I've documented certain types of different DeFi knowledge into this system. So this is a fully trained DeFi genius. I wouldn't maybe not go that far, but this thing knows everything that we teach and everything that we do and all of our strategies and all of our frameworks within crypto and DeFi. And it's fully aware of your portfolio. So when you go to the portfolio tab, this protocol, this platform can see all of your positions, whatever liquidity positions you're running, your lending and borrowing positions on Aave. We do Moonwell now as well. If you have a leveraged liquidity position on Revert, you can get that. Your spot assets, coin sitting in your wallet, it gives you your delta exposure, which is kind of keeping track of your short positions versus your long positions. I don't have a GMX position right now, but if I did, that would show up here as well. So it tracks everything. And the AI has full visibility into all of this. So you can actually have a useful conversation talking with the AI, and it knows your situation. It knows all of your positions, and it knows all of our frameworks and all of our instructional content. It's going to be able to help you, guide you along the way into fully managing your crypto and DeFi portfolio. So we're really proud of this, and it just keeps growing. We're building in new capabilities. For example, I have a fee tracker app that completely replaces the whole spreadsheet tracking of keeping track of your yield and your returns on your liquidity positions. So that we'll deploy that very soon. Just need to finish up some last little bugs and whatnot on that. So yeah. Anyway, getting back to the strategies, we talked about shorting the market on GMX, or you can use a different perpetual futures exchange. I like GMX a lot because it's completely decentralized, and I have full custody of my assets all the time. We talked about shorting an asset on Aave, borrowing it when the price is high, converting it to dollars, and then when the price drops, you buy that asset back at a low price and pay back your loan with ETH. So the third strategy is just providing liquidity. We talk about providing liquidity on this channel all the time. And for this, I want to give you an example of a liquidity position that I recently did on SWE. But actually, before I do that, this is the current iteration of my liquidity position on Uniswap, and this is actually leveraged up a little bit on Revert. Look at the APR. So currently, this position now that I just moved my range on this position, so this is only about eight hours or so of data. So just $10.57 that has been generated in fees from this $13,800 liquidity position. The way that maths out, this is just a few hours of fees. So the APR, well over 10% a month. Now, this is not always, you're not always going to get these kinds of numbers, but especially in a bear market, when the price is selling off briskly, the yields tend to be quite high. Now, I actually have a strategy where I put two of these strategies together in one. And I recently played this out on a different ecosystem, a different blockchain called SWE. So first of all, let me show you the setup for this position and this strategy on the SWE chart. Okay, so we recently had a very strong rally in SWE back here. Okay, there was some different news items that happened for the SWE ecosystem, and it just went bananas here, parabolic price action. And I thought when I saw this play out, I believed that the price was a little overdone. And I saw this as an opportunity to not only short the market, but also to provide liquidity with the borrowed capital that I use to short the market. So let me explain this. So the first thing I did, excuse me, let me bring up the other protocol here. Bear with me. My internet, for some reason, my internet today has been not awesome. So I utilized a lending and borrowing protocol. It's like Aave, it's just a different protocol. And this is the main lending protocol on the SWI blockchain. Fantastic blockchain. If you haven't looked into SWI, I definitely recommend doing your research on the SWI ecosystem. I think it's going to be quite big in the months and years ahead. Anyway, because I believe that price was a little frothy, a little overdone, a little too high, and I suspected that there would be some kind of a pullback. I didn't know if it would pull back and then keep going higher, or if it would just pull all the way back and come back down to below $1, which turned out to be the case. Sweetland is not cooperating. So let me just talk you through what I actually did on this position. Now, I'm going to turn on my buys and sells. So the first step that I did with this is, again, I wanted to short this market. I thought the price was overdone. I thought it was going to pull back or maybe drop completely back down. So I wanted to set up a short position. I utilized Sweeland because it's like Aave, it's a lending protocol. And what I did is I borrowed 4,000 SWI tokens. Okay, I borrowed 4,000 SWI. That ended up being, the price was $1.37 when I sold it. So it was just under $5,500. So I borrowed that capital. It wasn't in my wallet. It didn't come out of my bank account. It wasn't from Coinbase. I just borrowed it from the protocol, which obviously I already had some collateral on that protocol, and I was able to borrow that SWI. I didn't borrow USDC. I borrowed SWI. That was an intentional decision. Once I had that 4,000 SWI in my wallet, I sold it. I've sold about 90% of it. The reason I sold 90% of it is because I wanted to use that $5,500 to set up a liquidity position. So again, this is the third strategy to make money in a bearish market. You set up a liquidity position and you get paid when other people trade the asset. This liquidity position that I set up was a SWI USDC position. So when you provide liquidity for a decentralized exchange, you're always providing the two tokens. There's thousands of different pairs to choose from. In this case, I wanted my liquidity pair to be SWI and USDC because this is the price that I was trading and paying attention to. So when I set up this liquidity position when SWI was $1.37, take a look at my range. So you could see the top of my range and the bottom of my range, and the price was right about, that's not good. Let's try again. Price was right about there. Okay, now think about a liquidity position. You're providing liquidity for traders to trade. And that means if traders buy the asset, it's your liquidity position that sells the asset. And if traders sell the asset, your liquidity position buys the asset. Okay, so if traders are buying, you're selling. If traders are selling, you're buying. That's the way liquidity provision works. So think about what would happen if traders continued buying. Where's the price going to go? If traders are buying, the price is going to keep going higher. So this portion of my range, this needs to be SWI. Think about it, if traders start buying, Who are they buying from? They're buying from me because I'm the liquidity provider. So I need to have this shelf, so to speak. It's like opening up a store where you have two shelves. One shelf is loaded up with SWI tokens, and the other shelf is loaded up with USDC tokens. So this is my SWI shelf up here because I need to have SWI in case the traders keep buying. I got to have SWI up there to sell to the traders. Likewise, if traders sell, this lower portion, this has to be the USDC. If traders are selling SWI, my liquidity position has to buy that SWI from the traders. And how do I buy SWI? Well, I got to pay them USDC. Now, all of this is completely automated. This is a smart contract that's doing all of this. But the point is, out of that 4,000 SWI, I sold basically 90% of it. And so that way I would have the USDC that I needed to deposit into my liquidity position. Okay, so first step, borrow 4,000 SWI. Second step, sell 90% for USDC. Okay, now I load the SWI and I load the USDC into my position, and the traders do whatever the traders are going to do. In this case, they kept on selling. I don't want that. Let's go back to this. The traders kept selling SWI. Meanwhile, my liquidity position was spending all of that USDC buying SWI from the traders. By the time the price got down to here, I don't have any more USDC left. My position spent all of its USDC buying SWI from the traders. And meanwhile, every single swap, every trade generated a fee, and I earned my portion of those fees. So this is the third way to make money in a downtrend. As the price traded down from the top of my range down to the bottom of my range, I was generating fee income from that. And if I remember correctly, I think my average yield on that while it was in range was about 145% yield. It was just several days, but this kind of naturally unwound the short position because, again, when you go short, you're selling the asset at hopefully at a high price, and then you're buying that asset back from the market at a lower price. In this case, the buying back, it is autopilot. My liquidity position just does this for me automatically, assuming the price does this and goes down towards the bottom of my range. Now, it didn't have to go out the bottom of my range, but it did. So by the end of it, I had bought all that SWI back. I sold it at $1.37, and then my liquidity position automatically bought it back at lower and lower and lower and lower prices. So that was profit too. I profited from the short trade playing out, and I profited from all the fees that I collected as that dropped down through the range. Okay, so there's just so many powerful strategies and ways to profit in DeFi. It's absolutely fantastic. And what we're doing right now on the channel, I forgot to bring this up as well. If you go to our YouTube channel, which you're on right now, we are doing a new series, okay, where we're completely showing all of the steps to build your own crypto and DeFi portfolio. So step by step, going through the entire process, where you're going to start out by getting on chain with your own private blockchain wallet, and all the way at the end, you're going to be generating daily cash flow from your crypto assets. This is a big part of it. We're not selling our assets. We're leveraging our assets. And then we're borrowing cheap capital against those assets and using that borrowed capital to generate the cash flow. We call that the DeFi carry trade. And what that means is that you're borrowing capital at a relatively low interest rate, right? I mean, look at these interest rates. 4.3%, 2.25% to borrow ETH. So we're borrowing low, and then we're deploying that borrowed capital into a liquidity position that earns a much higher rate. Okay, so it's interest rate arbitrage would be the technical name for that, or just simply the DeFi carry trade: borrow low, earn high. So that's really the main bread and butter for our strategy that we use. All of this is available for the first time in history to ordinary average investors like you and me. You don't have to be a billionaire or even a millionaire to participate in these kinds of yields and these opportunities. Now, DeFi sort of lowers the barrier to entry and makes this accessible, and these kinds of strategies and returns are available to anybody with an internet connection. Really a lovely opportunity. And what I was trying to point out is this video right here. This is video number 1 in the series. I just rendered video number 2 last night, and we'll post that on the channel pretty soon. So watch those videos, literally just copy what we're doing there. Always start small. When you're just starting out, you're probably going to make a mistake or two. So there's no reason to jump into this with thousands of dollars. You can start out with $50, okay, or $100. No problem. The percentages all work out the same, whether you're playing with $100 or $100,000. The percentages are all there, and they're all the same. So it's a level playing field for everybody, no matter how big your investment capital portfolio might be. Okay, so other than the new series, again, video number 2 coming out very soon. Also, tune in for the live stream every Thursday, 6 p.m. Eastern. So make sure to subscribe to the channel and turn on those notifications. That way you'll get that notification. You'll get that alert that, okay, Brandon is going live. And you know, the opportunity is to ask me questions. I'm an open book. If you're having any issues with your crypto and your DeFi, by all means, let me know. I'll be happy to help. I'll even demonstrate different things on screen here. So that's going to be it. So I appreciate everybody tuning in, and we will be back again next week, same time, same channel, Thursday, 6 p.m. Eastern. Hope everybody has a great weekend. Thanks. Bye for now.